Good morning, everyone. Today is the second day of our conference connected with PEPP regulations, and now we will start the third panel. Before that, we have a keynote speech from Professor Portability from University of Bocconi, Milano. Professor Portability, are you here? Okay, I think that there is a small technical problem, so we will continue on our work, and after that we will give the floor to the Professor Portability. So today, third panel from our conference is the customer in the center of the long-term retail savings and investment products. The panelist today is Tatiana Bitunska, chairperson of the Bulgarian Actuarial Society, Gloria Dimitrova, member of Association of Bulgarian Insurance, Javor Achev, country manager of Amundi Asset Management for Bulgaria, Martin Parks, managing director member for BlackRock Global Public Policy Group, and experts from the Financial Supervision Commissions. And today's sessions will be led from me, and my name is Radostin Vazov, Vice Rector of VUZF. The third panel is the customer in the center of the long-term retail savings and investment products. We hope here to learn more for the rights and the protection of the client. Here we have representatives of two groups of potential providers: insurers and asset managers companies, and actuary. We will discuss the advantages of the PEPP and why a saver would prefer PEPP to another product. The panel will start with a keynote speech that I mentioned already with Professor Portability, and after that we will continue with the questions from our panelists, and after that I will give the floor to the audience to have their questions for the discussion. So, till we are waiting for Professor Portability, I will ask my first questions to our panelists. Tatiana Bitunska, do you think that PEPP framework will influence the other alternative products and activities? There is a problem with the sound. Can you check your microphone?
Apologies. Good morning again, everybody. It's a pleasure to be part of this panel discussion. As not only chairperson of Bulgarian Actuarial Society, but I'm since 2008 permanent member of Pension Committee of the European Association of Actuaries. And since October, I'm the current chairperson of this committee as well. So we had very intensive discussions last year regarding coming finalization of PEPP regulation. And as it was mentioned several times yesterday, I would agree that PEPP framework is intending to provide environment for very simple, easy to understand, wide applicable, and allowing mobility of the customer's product. Several times yesterday it was pointed out that in Bulgarian on Bulgarian financial market we already have some similar products. So I wouldn't expect any significant impact and influence that new PEPP regulations would have on the Bulgarian market, with except probably of the regulation of the payout phase in the mandatory pension fund area, which is still unsolved issue. And in that regard, in that respect, probably the influence of the PEPP products and initiative will be positive for our market. That's my expectations, but I couldn't expect significant influence on the customers, even if we took into account cost cap. Universal pension funds are operating in very similar framework, I think.
Thank you for your answer. And now I have questions to Martin Parks. Martin, your work in one of the biggest asset managers, BlackRock. What is the interest of BlackRock's clients in the PEPP market? The sound. Can you switch on your microphone?
All right, there we are. Sorry, it's a different mute button from the normal system I use. So apologies for that. No, thank you, and good morning to everyone. It's a pleasure to be here. So when you ask us about what the interest our clients have, I'd like to just take a step back and say, for pensions products such as a PEPP, there are three key building blocks that you need to have as a provider. One is you need to have the investment solution, you need to have the distribution solution, and you need to have the administrative solution. There is a lot of record keeping, member requirements, and especially on something like PEPP, which is cross-border, you need to be able to do all the tax accounting. Now, BlackRock's expertise is very much on the investment side. And certainly we have a long experience in a number of markets on providing life cycling strategies. And we know to the European level that traditionally there has been a lot of focus on defined benefit and on guaranteed schemes. With longer term, with the prolonged low interest rate environment, those traditional solutions are under a huge amount of stress, and that therefore investment solutions which can provide a better longer term return will be of interest. However, you simply take the fact that if you had a lifetime pot of 100,000 euros and you had a 5% government bond interest rate 10 years ago, and you look at the negative interest rate now, there's a clear interest in looking at different ways of generating return. However, that's only part of the question. However interesting the investment solution is, you also need to have the distribution solution and the administrative platform to do this, especially on a cross-border basis, where pensions have traditionally been very much managed on a national basis, and there's still relatively few cross-border platforms. So we're very much at the process at this stage of looking and talking with distribution partners who are looking for solutions to help move their clients, let's say from underperforming deposits or guaranteed products into high-yielding products while managing risk exposures. I don't see a massive rush yet, as there's still a number of building blocks which need to come together, which are very much those distribution building blocks and that administrative building blocks. However, that doesn't mean the product should be written off. Quite the contrary. I mean, pensions are a long-term game. And I think quite often we fall into the trap of looking at the PEPP as we'll create this great product, it will be the killer app that everybody will jump on immediately. I don't think pensions work that way. I think this is something you bring up over a number of time. And I will say if from an asset management perspective, UCITS 3 products using derivatives to manage volatility took 7 or 8 years to really gain a lot of acceptance. The European LTIF product, the European Long-Term Investment Fund for Retail Investors, has been, in theory, has been around for a number of years. I mean, BlackRock has a couple of those products, but there are only about 30 in the market at the moment. And it takes time for advisors, distributors to understand the product, look at the opportunities, and then understand how products can be launched under it. So our expectation is to see an incremental process with more PEPs coming to the market as the wider market becomes familiar with it. So no big bang just yet, but something we remain very interested in because of the fundamental interest around the investment solution. Thank you.
And now I see that we already have Claudio Tebaldi, Professor. Good morning, Professor. How are you? Everything's fine? The microphone, please. Can you switch on microphone?
Hello, everybody. Sorry, I was trying to connect to the wrong link, or the right email with the wrong link. So that was the reason of the delay. So thank you for the invitation. I will try to share with you my screen. Okay, so thank you. So, I will try to give, I share most of the considerations I heard from Martin Potts and also in the yesterday conference. I will try to give a contribution. Can you see my slides, please? Can you confirm that you can see my slides?
Not yet.
No? So, okay, condividi, okay. Can you see the slides?
Yes, I think that now, no. Yes, we see it.
PEPP regulation standards, okay. Can I go on?
Yeah.
Okay. Perfect. So, I will try to give, let's say, a broad view. Let me call it a macro view, but I hope it will macro, but useful for to understand, my view about these important regulation standards that are being discussed, and they are a second part of the important discussion. So I would take as a original. As a starting point to see which is the broad view, this important quotation from the final report of the high-level forum on the Capital Market Union. We know that there is a problem, in the functioning of the European capital markets, and in particular on the demand for financial services, because there is this widespread perception that financial markets are not serving citizens well enough, and that is mainly wealthy individuals that benefit from capital markets. So it's a hard statement. It's a statement that in a way we have to accept. There is something that we can do much better, that is providing financial services. And luckily now PEPP and the regulation standard, we are in a way, I think we are in the right track trying to fix this issue, this problem that, by the way, has an important outcome in terms of cost that we are paying, both from the demand and supply of capital. We know, for example, that the main implication of this situation is that many people do not invest, are underinvesting, they keep their money into their cash accounts, and this over the long term, it's a big cost. It's an important big cost. Okay. By the way, why I'm starting from this very general consideration? Because, the goal of any regulation, but in particular of the PEPP regulation, we cannot forget that it will be to foster higher demand of retail investment opportunities, to foster higher demand for long-term risk appetite. And by the way, once you enter into this very hard task that is pension investing, well, you need at some point you will need better financial advice and better financial services. So in a word, I would say that one important goal that this regulation overall, technical and the regulation at the first level regulation, it's just to set the stage, it's to foster demand, to be able to match better the capital supply and the capital and demand and supply of capital. Okay, so within this big framework, by the way, we want to focus on a very special type of products, a very difficult type of products, because as Martin was suggesting, was saying, it's a slow trend, the one that can modify the choice and the way we manage pension investing due to the long-term investing nature of this type of products, the type of services that are hard to control, hard to verify. And by the way, the rules of the game, the technical standards are important part. It is the typical situation where the evil may be in the details, and until we don't have, unless we have a completely working, I would call it a completely working ecosystem, it's not obvious that we have a successful regulation, that we have a successful products that may improve the situation, may foster demand. That is, in my opinion, the main goal that, it's relevant both for consumers, for providers, and by the way, for institutions. So, as a general comment, I've been interacting at many levels and with a lot of professional regulators, industry members, and I must say that I've been really admired for the level of professional level. And I think that in a way, let's call that the level 1 and level 2 regulations are achieving an important goal. That is what I would call restoring trust. Why? What's the problem? We know this, I will be a little bit harsh on that, but this is the situation. We have to be clear. We have to accept that following the financial crisis, the common perception was that the profits from financial technology have been captured, that the financial sector retained most of the benefits while downloading the cost on the consumers of financial services. And so restoring trust, it's a necessary condition to foster demand. And from this point of view, I would definitely say that the PEPP regulation, it's a regulation that achieves this goal. It's an advanced regulation. It's a new regulation. It's not a regulation that we borrow from, say, Anglo-Saxon markets, from other markets. It's a truly European important step toward a protection of the investors. And by the way, it's so strong that, I will mention the introduction of the notion of risk mitigation, the cap of the cost, that as I understand, it's really hard. It's a hard cap. It establishes, and then it's definitely an important issue, that a level playing field that hopefully will foster more competition and better products. So, by the way, let me say, I can understand that all these topics generate a lot of problems, generate the necessity to struggle a little bit to produce some new contracts, a new device that is in a way competitive, market oriented, and may in a way may foster this demand. But however, I would say that given the premise, and the premise is lack of trust, I would consider these targets, these objectives, as a necessary condition, because we cannot forget that if we must have in mind that the goal of this approach of the new regulation is to improve, to give people incentive to invest more. It's a scaling in a way target, the one we have to accomplish. So it's not a problem about dividing a cake where the cake, the size of the cake is fixed, and it's only a problem about the division of this cake. We have potentially a huge and enormous market. The big problem is that this market is slowly moving. There is a lack of trust, and this regulation establishes an order zero condition that is, we know that from the research from the academia, is meant to restore trust on financial institutions, on the financial industry. And I think this is an important explanation of the decisions taken at the regulatory level. And focusing more on the work that has done EIOPA on these technical regulations, I must say that EIOPA has done an impressive technical work at trying to implement this non-trivial notion like the risk mitigation. And as I was saying, it's an approach that in a way it's a European way, and we should be proud of that, because especially after Brexit, we have to find our own way to capital markets. By the way, there are some issues, as I heard Sandra and other people from the regulator say, this is a sort of a good kickoff. We expect that this regulation may evolve, may become user-friendly. I can understand that such a hard regulation may not be at present, an easy path for the providers. The providers are, by the way, those who should match, are expected to match demand and supply of capital. And by the way, this is the hard part. We don't want to kill the baby with too heavy a regulation that is too heavy. And from this point of view, I would say that we have to find some suggestions, going back to a tradition, a sort of regulatory tradition that is not the one common to continental Europe. We should go more in a direction of a common law environment. In what sense? Well, first of all, I would say that we have to consider the problem that too heavy regulatory burden may kill the baby. So from now on, I would say that still we are in a perfect condition, that all the work that is being done, it's well streamlined. But from now on, it's definitely the case that we hint more to transparency. For example, I've been suggesting, and I will continue suggesting, that the best way to control the cost is especially to have a competitive, efficient products. It's not sorry to have caps on cost. It's being more transparent in the cost and the relationship in the trade-off between the cost and the services. So in my opinion, I know in the law there is this heavy cap, but I heard yesterday some interesting proposals to accomplish this task, but maybe trying to separate and identify in a more precise way the cost. But to identify the cost, there is no way but transparency. We have at least exposed to be able to identify why I'm paying, which is the service I'm paying. Because at present, it's unclear what we are paying for. Because, by the way, we want a product that mitigates risk, but we want a product that produces an efficient outcome. So, for example, I think that a better understanding of the price of the guarantee, I'm not saying that the price of the guarantee should be inside the cap. I'm simply saying that everybody should be aware of the cost he is paying to reduce volatility, right? And so I would definitely suggest EIOPA and the regulators to set up, let's say, a set of data, and possibly to give access to this data to the researchers, because especially in this long-term investing, there is a tremendous lack of information. Standardization of the products is a second important property I would suggest in order to streamline this market, because we have not to forget that, again, I want to stress this, we are in front of a market of, a potential market of almost 500 million investors. So here it's clear, as somebody was suggesting yesterday, that the way to improve this market is to look at scale. So we are essentially focusing a market that can have an economy of scale, tremendous economy of scales for the providers. So even a 1 basis point or 100 basis point over a big millions of investors may have may be a great source of profitability. We have to learn from the big international firms, from the big international markets. So our competitors are China. We have to look at China. We have to look at the way US markets move for pension investing. And I think that this is one of the early legislations where we can play our role. We can, in a way, also lead some innovation. And finally, one thing, one big question mark, it's about the distortionary role that regulation may have in terms of products we sell, in terms of investment we have. This is more or less my last message. I think it's an important message. So I see this is a shared view, I wish you, that in a way the status quo of this regulation, it has a hidden distortionary role, in the sense that it's a regulation that is volatility averse, market volatility averse. But this is an attitude that, in my opinion, it's a little bit. It's not considering the real situation of financial markets now, and in particular, it's not considering that volatility can be controlled essentially from the thanks to the monetary policy, thanks to the action of the central banks. While the big issue over the long term, it's not most likely the biggest. Risks for the pension investments are no more concentrated only on volatility. Just to make more precise my statement, and sorry, here I'm moving a little bit out from the pension product regulation. As a final consideration, I want to give you a consideration over the situation of general financial markets. Is that I think that even if we are in such economic exceptional macroeconomic conditions, there is consensus on the fact that the pressure on fixed income markets has reached a tipping point, that the scarce resource is the long-term equity capital. And by the way, this is especially important for European firms for the demand of capital that by the way will drive prices in the far future and say 5 years from now or so. For example, I take this quotation from a recent paper. All great economic crises, and so especially the COVID crisis, pose two equally important challenges. The drain of the liquidity, and the monetary policy is answering to this question, and the functioning of firms, and by the way, the equity capital. So the depletion now is in equity, it's in equity capital. Just to give you a Financial Times suggestion, you see, we have a huge opportunity to replace lending, to replace debt with equity purchases. So in other terms, the general financial markets are moving in a direction where before or later there will be the necessity of more equitization. So what is really important, and this is possible thanks to the innovative character of the PEPP, it is definitely important that all the regulation, and when I say all the regulation, I include also the revision in the solvency standards, are able to face a situation with these ultra low interest rates where it's a necessity to move further into more equity-oriented investing, because if, by the way, there will be a market only if there will be a matching between the demand and supply. So I think that the major issue that everybody should take into consideration, also in the design of the new products, I think one important challenge will be the production, the creation of new products within this PEPP scheme that sets a stage that is suitable for that, to remove volatility aversion, to remove this, by the way, this has not to be done at the cost of rising the drawdown risk. I'm well aware that we are talking of pension products, but it's obvious that if you want to have scale, if you want to have a larger market, that will imply, in the next future, a shift, a great shift, a great collaboration between industry players to produce products that help, especially help the market in matching the great demand of equity capital that will certainly characterize our economies in the next future. Okay.
Thank you, Professor Tibaldi. Now we continue with the questions. But before that, I think it's good to present our panelists because I make a short presentation to them what they're working now. But I think that their views are really interesting, and our audience is good to know who is our panelists. So I'm starting with the Professor Claudio Tibaldi. Claudio Tibaldi is a tenured faculty member of the Department of Finance in Bocconi University, Milano, associate professor in the field of quantitative methods of economics, finance, and insurance since 2011. He holds the national qualification of the full professorships since 2015. And he has a lot of publications in this field in leading journals like Review of Financial Studies, Management Science, Journal of Financial and Quantitative Analysis, and so on. A really interesting and interesting biography. Thank you that we have you here, Professor.
Thank you for the invitation.
Martin Parks. Martin is responsible for engaging with policymakers and BlackRock clients in policy and regulation relating to the investors protecting and distribution, retirement and fund structures in the EU and UK. He chairs the Investment Association of International, the European Policy Committee, and it is a member of the IMF's Post-Trade Consultative Committee. He regularly contributes to the work of key assets management trade bodies such as EFAMA and ICAMA and ICI, and the Investment Association, ILFI and ICI. Martin has worked at BlackRock since 2004. And prior to joining the public policy team, he worked in BlackRock's legal team responsive to BlackRock's European Management Investment Funds. Martin studied European law in the University of Exeter and the University of Adric Marcel, and he is a qualified solicitor in English in England and Wales. The next panelist is Tatiana Butinska.
Welcome.
Thank you. Tatiana Butinska, President of the Bulgarian Actuary Society. Tatiana has expertise knowledge of the various aspects of life insurance and pension insurance market. She has a solid experience in the due diligence and acquisition projects, and well as in strategic planning activities. Among the other topics, Tatiana also keeps to focus on the Pillar 2 capital schemes at the new PEPP regulation, and in 2018-2019 she worked as an external expert of the Ministry of Labour and Social Policy on the concept for paying out pays by mandatory UPFS Pillar 2, and so on, so on. She has a really specific knowledge in this field, and thank you that we're having here Tatiana. Our next panelist is Javor Achev. He is a member of Amudu Asset Management. And after that is Gloria Dimitrova. Gloria Dimitrova is the General Director of the Market Management and is responsible for the customer satisfaction brand and communications of all companies in the Allianz Bulgarian Holding Group. She began his career in the Insurance Supervisor Directorate, then continues his professional development at Marsh and McLean and ING Life and Unica. In the period of 2017-2018, she was elected as the Chief Executive Officer of the Allianz Bulgarian Life Insurance Company, after which she took over the management of market management of Allianz Bulgarian Holding. Thank you for being here. And now I want to continue with my next questions, these questions is to Javor. How the investors behaved during the recent market correction at the beginning of 2020?
Yes, hello everyone, and would like especially to thank for the invitation for the event. We have some very interesting observation. First, I would like to take from Professor Tebaldi that the cake in Bulgaria is also growing. Especially if we see the deposits of individuals in banks, they're growing quite steadily at the annual rate around 8-9%. I remember just a couple of years ago, the total deposits of individuals were 20 million euro. Now they're close to 30 million euro. So really, it's a very good condition for all our industry to develop. And regarding your question, we were in Bulgaria present also during the great crisis of 2008-2009. What happened there is, of course, a lot of redemptions, a lot of emotional decisions by the investors. And at that time in Bulgaria was a period when we remember the interest rates on bank deposits went up dramatically because the Bulgarian banks needed to have additional resources, additional funding, so they increased the interest rates on the deposits. Completely opposite is happening now. First, Bulgaria is applying and is in the ERM2 mechanism for joining the Eurozone. The banks are over-liquid. The deposits are, the interest rates on deposits are practically zero, like in the other European countries. There is no prospect to be increased in Bulgaria, the interest rate environment. And despite this fact, the deposits are growing. We can speak for that further on. But what happened with the investors? The investors in our funds, they didn't redeem during the current crisis in February, March, this extreme bear market. We remained on positive net sales. This is completely opposite on the previous crisis. I think two factors are, it's due to two factors. One is that the investors and the distributors, it's very important, gained, even in Bulgaria, some experience how the financial markets we don't have to go back to 2008, 2009. Only if we remember 2018, when December 2018 was one of the worst December in history for the financial market. 2016, the beginning of 2016 was also one of the worst beginning of calendar years in history. So this is a recent market turmoil that our investors pass through, our distributors pass through, they remember, and during this financial crisis, I think it played a role not to witness such redemption as before.
Thank you, Javor. And my next question is to Gloria Dimitrova. What characteristic of PEPP you think you are important for the clients?
Well, good morning from my end. I'm happy for being here. I was able to attend most of the presentations and the discussions in the previous day, and I find them very insightful and valuable. I believe that after this event, we all will be getting a better understanding of the opportunities and, of course, the challenges that the PEPP is going to bring on the financial markets. And now on your question, I have to say that I find the whole PEPP concept quite disruptive, but in a good meaning of that word. Especially when we compare it to the existing product and services, and having in mind that it comes from the policymaker. It's known that the financial industry has been in the center of the digital vortex for quite some time. We have been seeing a lot of fintech companies entering the market and getting enormous success by providing different type of values to our customers. And those are cost value, experience value, platform value. It seems to me that the product is designed in a way to meet at least two of these values, namely cost value and the experience value, which so far has been addressed in terms of distribution only. But I fully agree with Martin that also the contract administration should be considered as well. It's a transborder product intended to provide millions of people for their well-being when retired. I believe, colleagues, that if we don't take the opportunity and the advantage of these unique market initiatives, fintech companies will do, one way or another. The product has been developed with the customer centricity in mind. It's supposed to be simple, it's supposed to be cost efficient, it's supposed to be transparent as well. All these are features of the products that the fintech companies are delivering. One of the product features that I think is going to be very attractive in particular, it's the mobility and portability. Now people in Europe, young generations, and we all actually, given the existing environment, are used to live in one place, work in another. So having a product that we are able to carry with us, it's going to be a huge advantage. The product itself is simple and transparent. I fully agree that cost should be shown in a very transparent and easy to understand manner. And I think this has been achieved in the present key information document. It's not going to be simple to compare the different investment products that are on the market, because there are many, their features are different, their parameters are different, the information that the providers have to show to the audience is different. But I believe that distributions and the providers will come up with a digital solution that will be comparing those to the extent that they come up with a personalized proposal to the customer, where customers will be inputting their data through certain calculators, And then they will be given a few options that they can look into more details further on. I think it's a big advantage of the product that is intended to be distributed digitally. But I also think that probably at a later stage, the regulators need to consider digital contract administration as well, because this actually will enable cost efficiency for the providers and for distributors. I have to say I'm very impressed in the way the key information document looks. It's designed with the digital concept in mind. It follows the templates and the documents that are used by the fintech companies. I think yesterday one of the panelists made a comparison between the PEPP kit and the kit under the PREP, and it was clearly in favor of the PEPP. So it's easy to understand, supposed to be digital, and it's supposed simple and transparent product. And all these are features that I think the young generations that are supposed to be our customers in the years to come will highly appreciate. Yeah. Thank you.
Thank you very much. And now I have questions to Professor Tebaldi. Professor, how you will convince the potential saver that PEPP is a safe product? And one more question according to that. You mentioned in your presentations that more than 4,800 million people is a potential market. Is that correct? I'm not wrong. What is your opinion? The market influence in what will be the market influence of this product in countries, in different countries in Europe? What will be the percentage of market influence according to these numbers?
Okay, thank you. So it's definitely, I share most of the considerations done by Gloria Dimitrova and about the role of transparency of technology. I did not mention the fact that we have a big, we are in front of a big shock, the COVID shock, but we're also in front of a big technological shock. We see that it's really fast, the transition to fintech, to a digital transformation of the financial market. Well, the potential, the advantage of the PEPP is standardization. Just to make, I heard, just to mention, well, this issue, I remember Vittorio Colau was the CEO of Vodafone, and he said, if I have to ask for a new license in China or in US, I ask for one license and I will have access to, hundreds of millions or even billions of customers. If I have to ask for a new license in Europe, to have access to all these people, I will have to ask for 20 or 25 or 30 licenses. So clearly, the standardization and the streamlining, carried by the PEPP opens a lot of economies of scale, given that the product is it's exactly designed and fits within a market that has to be a unique one. So it is definitely appealing for the generations that are also moving across border in Europe. By the way, the fragmentation in markets and the transparency are, the removal of the fragmentation in markets to achieve a better performance, an internal market performance. And second, the transparency of the conditions, the grant that, in a way that there are no hidden details that may, in a way, reduce the efficiency of the product. This will be certainly the important bar that we have to overcome. So I would stress, also I saw a question in the chat about the separation between the cost of the guarantee, the cost of the fee, whether it should be included or not in the fee. Well, there is a lot of heterogeneity in the products that can be offered within the PEPP, and I consider that a plus, an important factor, because this hopefully will spur innovation. I consider the products still insufficient in terms of the potential we have. But by the way, the only way you have to guarantee that all the products that the market is proposing are properly priced, they produce, they fulfill a sort of correct trade-off between the quality of the product and the price you pay for the product. The only way is to make this product, let's say, this trade-off available to consumers. It's crazy. I think it's crazy. I joke with my colleagues about that we all teach option pricing. We all teach in our universities how to price minimum guarantees and so on. But then if you want to know which is the long-term value of a minimum guarantee in the real European capital market, nobody knows that, right? It's a most well-hidden secret, and I suspect that this is not by chance, right? So push the regulators trying to have a better understanding of this data. And I've been interacting with the regulators. They are the first who understand this need, but by the way, having data, collecting data in a common way, in a fair and transparent way, requires to have a standardization of products. So I think that we are at a critical point, because whatever the product you are willing to provide, if you want to provide to a large audience, you must standardize, you must accomplish with the minimum standards now that the PEPP in a way is setting. So in this sense, you know, I think that this is an important lesson, important advice we must take from other markets, the Chinese markets, US market. All these markets are far more standardized and less fragmented than our, even in terms of regulation, of information provision and so on. And this, I think, it's something that is feasible to standardize our information, our knowledge, and that will definitely work in favor of transparency, fostering demand. That I stress again, it's in a way something where everybody should agree. Okay.
Professor, and my next two questions is according to Martin and his expertise. The first question is, in your opinion, which group of customers are the most potential savers in PEPP? And the second question that I think is related to that, what are the advantages of the risk mitigation techniques to potential PEPP saver?
Thank you for that. Really, sort of these both questions are really at heart of the attractiveness of the PEPP. So looking at the question of who's likely to buy the PEPP, and how do we make it attractive to them? I think that there are two ways of looking at this. One is you can go in and a sort of very much a traditional gap analysis. You look country by country. You look at the pillar 1. You look at the pillar 2. You look at pillar 3. You look at people's replacement savings rate and what replacement income should be, and you can identify various groups who are underserved in national pension systems, and this can be for a whole variety of reasons. One particularly thinks of the self-employed, or individuals who have, by work patterns, have a lot of gaps in employment. And this may be you have a gap not simply because you haven't been working, but because you've been working outside your home country. And the whole question of portability can be really important. So people who really prize a portable product. I mean, this is something that we've seen in other systems as a sort of key issue. If you look at the success of the Australian system, for example, that has been really undermined by portability, the ability to change employer, that that your pension comes with you, that contributions go to the PEPP that you choose, that to the super scheme that you choose, rather than the one that's chosen by your employer. So it stays as your pension. So a portable product, the portability of the product, I think, is going to be really important. So we can do all this gap analysis, and and we will see certain cohorts who are really in need of the PEPP. And certainly have some examples, certainly some thoughts that we have cross-border workers. We know if you look at firms who are in the EU who have cross-border workforce, clearly they have the option of setting up an IOP, but that is quite expensive. It is quite demanding in times and administration. And let's say you are a fast-growing SME who just wants to expand in into markets, in your neighboring markets. You're probably not going to get to an IOP pretty soon. So the ability to, let's say, contribute or to encourage your employees to contribute to a PEPP could be a way of supporting your employees as they go forward. Now, I know in the whole PEPP process, talking about Pillar 3 workplace pensions is taboo, because people have said this is an attack on the traditional national systems. However, there are a number of the workplace is key, and when we look at the Plan d'épargne retraite, the retirement savings plans in France that have recently been introduced. Those are Pillar 3. They are brought in as an additional employment benefit on top of the existing Pillar 1 and Pillar 2. So there are a number of options. So that's very much how you push the PEPP out to people. I think you can also pull people in, which is something we haven't explored as much. And the professor talked very interestingly about the CMU. And one of there's two recommendations in the CMU high-level forum were about pensions dashboards, and they were also about auto-enrollment. So I'm very interested in this whole area of standardization of data transparency. And that is something that a pensions dashboard can be really powerful. What we've seen in many countries is that pensions entitlement is totally fragmented. People have no idea what they are entitled to and what their retirement income is going to need. And therefore, they have no idea that a PEPP might help them, of what additional support might be useful. So having a pensions dashboard where you can say, first of all, how much I'm entitled to under my state system, under my Pillar 2, and what's my gap? What's my lifetime goal? And there's very easy ways of modeling that goal. Again, I look at the Australian system when they say, do you want to go on holiday once a year, once every 6 months? Do you want to be able to what do you want to be able to do in retirement with your grandkids? And therefore, this is what you need to save. That sort of very visual modeling, which, if that is adapted to a pensions dashboard, can be a really powerful way of giving people to say, I'm not good enough. What do I need to do? If the next easy step is, here's a PEPP, here's a cheap standardized product which can help your needs. So that's one additional step. A second additional step is that we've seen in some countries is, and this is very much national issue, is auto-enrollment. Is that if you've got a very good, well-defined default product, why not say to people, we'll take the choice out of you, part of your savings will go into a product, such as a Pillar 3. Now, it could be a Pillar 3 national product, it could be a PEPP. To be honest, as long as people are saving more for their retirement, I don't really mind. But it is the idea of having an auto-enrollment product is you actually really have to focus on that issue of cost and standardization. And I know the UK isn't in the EU any longer, but the UK's auto-enrollment process has brought in 10 million extra people into pension savings. And it's an incredibly powerful tool. It also allows people to opt out. So it still gives people freedom to do something else. But most people, well over 90 to 95%, stay in the system. Finally, we just have the second question was really conscious of not taking up so much time, is how would you explain risk mitigation techniques to a PEP saver? I think one of the great thing about the PEP is avoiding complexity. A lot of studies showing that faced with complexity of products, people don't make a decision. Especially that's something that is long-term and complex, such as pensions. So life cycling takes the complexity out of this, because you say this is a product which stays with you as your life circumstances change. So really your decision is to choose a retirement date. And then you put that into the product, and the product stays with you and works with you. And then you decide how much you can afford to invest, and then you leave it alone. When you can afford to save more, you put more in. And we can do things like auto-escalation, which help make that decision even easier. So disclosure on that is really key. I really like the point made just now about the digital nature of the PEP kit. And that goes so much to what I feel about. I mean, the existing PRIPS kit was designed pre-iPhone. I mean, I do think it's a crying shame that if you look at a PRIPS kit document, you can't look at it on an iPhone. And an iPhone came out in 2007. It's 13 years ago. So we're looking for technology for 10 years' time. So we really need disclosure technology that is easy to understand for the next generation. So I'm really excited about the PEP kit and what it means in terms of digital disclosure. So really to close, that I think we need to bring these elements together. Is create the need for individuals. We need to find out which groups are in specific need of additional savings and target them. But also let's create consumer choice. And then when we describe what happens, let's just really make this a very simple explanation. We've got good examples in many other markets on how to bring life cycling to life that we can really use and adapt to the European model. And very much conscious of the Professor's comments that we are doing this for a European market. We're not doing it for an American market or a UK market. So, but we can make that disclosure talking about how you manage lifetime risk in as simple terms as possible. Thanks.
For your full answer. And my next question is to Tatiana, which is, I think is really related to the things that Martin says. Tatiana, what is your opinion about the two forms of capital protection in PEP, guarantee and risk mitigation techniques?
Okay, actually risk mitigation techniques are two to manage the risk, and it is not an alternative of capital guarantees. It could be designed they should be designed and chosen in an efficient manner to serve the intention which particular PEP scheme provide to the customers. It could be, as previously colleagues mentioned, to serve their lifetime needs, or just to establish additional reserves for particular purposes, or to cover guarantees. And in delegated regulation, I think Article 12 describe risk mitigation, the purpose of risk mitigation techniques, and how they should be proved in front of IOPA or national regulatory. Because PEP regulation set requirements for covering the base capital and or to covering inflation, the company should prove reliability of their schemes, and the chosen risk mitigation plans should be accomplished with stochastic calculation and assessment, giving the security level or confidence level at least 92.5% percentage, or in other way, it was said that every provider of basic PEPP should ensure at least in a time horizon of 40 years, at least covering the inflation at least with 80% above annual inflation rate. So all these guarantees or all elements that are provided as feature in the particular PEPP scheme, they should be secured by special mitigation techniques. And this is the more artificial part of the pension product, which require very cautious approach and of course expertise of the people on the market. As Professor Tebaudi mentioned already, it is one of the very tricky and difficult question for European market, how to assess capital guarantees, how to provide different type of financial options and guarantees during lifetime of the customers. It is also relevant to life insurance sector, to occupational pension schemes, but there is no common approach. There is no quite clear perspective and answers that is easy to be understood by a wide audience of the customers. And I was a little bit surprised by the result which EIOPA report on the focus group for understanding of the features and of the which PEPP is intended to cover. So EIOPA provides among three countries, Spain, Croatia, and Ireland, in the spring of 2020, a research. So focus group were asked how they understand the particular guarantees, how they feel, and are they able to calculate the total amount of fees and cost that one artificial pension provider, PEPP's provider, offer them. And the results are very interesting. It is a challenging task for average customer, even to calculate on annual basis what means 1.1% of the accumulated asset or on the saving amount. Because of all this consideration, I appreciated very much the approach described in delegated regulation, that in particular section of KIT document, all features should be described in very transparent way, and also they should be presented in such a way that customer will be able to take the decision. The other thing was requirement all features to be comparable with elements pre-described in PRIPS requirement. So it is also beneficiary for the local markets because it will help customers to make an easy compareness with existing products and alternatives on the market. But in any case, for wide audience, for wide target segment, which I expect to be users of the such PEPP's product, it is crucial to have a very simple and easily presented product. There are also some discussions and still not finally defined tasks like how to present the cost of guarantees, whether they should be disclosed separately, or they should be included in this 1% cost cap. But in any way, in kit document there shouldn't be more than necessity information, and the information should avoid any misleading of the customers or difficulties in understanding. I hope to answer your question. If I'm not, if you free to elaborate further. Thank you.
Thank you very much, Tatiana. And my next question is to Gloria. What type of distribution channel is the most suitable for PEPP sale? And do you have any studies for the savers' attitude to PEPP as a retirement product?
Well, given the cost cap and the cost efficiency that the providers and intermediaries will be looking into, I think that definitely the digital channel is going to be the most appropriate one for the distribution of this product. And it's not only because of the cost efficiency, but also because of the complexity of the product, the complexity of comparing it to the other investment retail products. I believe that without digital solutions, it's going to be difficult for intermediaries to explain to the customer one feature or the other of different products. So to me, the only appropriate channel would be digital. And also given the scale of this product, and given that our target audience are new generations and they're used to working with digital tools, what they do first is actually they check what is the information and the availability on the internet. And then they go into the details to compare providers, intermediaries, products, features, and so on and so forth. So definitely, to me, this is going to be the most appropriate one. As for the surveys, I'm not aware of any other survey besides the one that has been mentioned by the colleagues about the perception of the key information documents and the benefit statement, which was quite extensive, and it was done by the book. And probably that's why the outcome is that impressive.
Thank you. There was a small mistake from our side, so we interrupted for a second. My apologies.
Yeah, I don't know if I...
My next question is to Javor, and actually this was the questions that I said. Do you observe a shift toward electronic channels for investments, and are there any ongoing innovations in the financial industry?
Yes, we witnessed increased demand for electronic channels, and of course our distributors also have moved very fast in that direction. However, due to the specific of the investment products, we were joking that in the morning the people will come to work or at home, open the computer, drink a coffee. The first thing we'll see is the news or its investment, the value, the daily price, and we'll buy or sell if you have the possibility electronically under emotion and lose. So yes, we're moving toward electronic channels, but at the moment not allowing such a daily high frequency transactions. Still to have a human interface after the client, for example, clicks demands to have saving plans or investment in some funds. It's done automatically, but then a person contacts him to discuss really the intentions and the client objectives, and after that the deal can be concluded electronically. So yes, we're in favor of electronic channels, but having in mind the specificity of investment products, we are not fast moving goods.
to Professor Ibalvi. There is a question from our chat. It comes from Dr. Nikolai Slavchev. Do you think PEPP will pave the way to a European pension union?
Well, I hope so, but you know that this is a real challenge. What I forgot to mention, but I think it's important, is that while we are now talking about a private pension product, so the matching, in a way, there is a growing interaction between the public and the private, even in those countries like, for example, Italy, where there is a robust and important public pension system. We cannot forget that the way the pension system, the public one, reevaluates the pensions is essentially related to the GDP growth, to the economic growth. So fostering the better an improvement in capital, in demand for private capital into our internal market, into the European internal markets, and rising the importance of, you know, the flow of capital to the, I was mentioning the long-term equity risk. It's central, you know, we are doing ourselves a double important, we are playing a double important role because, by the way, finance, it's the engine that spurs growth also from the economic point of view. What the other side of the coin of what we are seeing, we are observing in terms of frozen deposits is that you know, we have not risk capital that is reaching good startups, and even if Europe, it's great from the point of view of technology, from the point of view of developing new ideas and so on, it's clearly missing of risk capital that can grow these firms at a level, at a scale that is comparable, that is competitive to the international standards now, right? Because we cannot forget that you know, we are essentially out of this information technology monopoly. You know, that we have no unicorns, we have no really important IT firms that have been developed, and this most likely is due to the lack of capital, of long-term capital that is investing in. So, you know, I stress that we have to look, this is why I decided to go for this macro view, because PEPP, it's you know, it's household, but it's 500 million households. This means that there are economy of scale that we can free only if we start with a simple, standardized, transparent way to make people more user friendly, you know, for the financial markets to look more user friendly. So whether there will be a European public pensions or not, I think that over the long term, well, we will need a unique market where, you know, we can invest, especially under the current demographic conditions. Everything in a way is highly correlated. The public system, the GDP growth, the private system, the possibility to have well-working financial markets. So we are all moving in the same directions, luckily. And this crisis, the COVID crisis, is accelerating this logic, as we have seen, because essentially this is the only protection, the only shield that we have with respect to a situation that would be really hard to face individually at the individual level. So we have started with, you know, the private system. In a way, it's easier to move. But I think that it will definitely be a big improvement if we can create a common framework. As I really like the Martin notion of a dashboard, of pension dashboard, where everybody can have you know, understanding, can have an information that is clean and it's transparent about their future, right? This is one of the major issues we have in Italy, that, you know, a lot of people as different type of job collocation. You know, maybe they have a low income from some stable public, and then they are topping up with some other, and all this fragmentation drives a big risk, a big pension risk, because most of the people is not aware of the real savings, of the size of the savings and the quality of life they are going to face into the far future. As I was mentioning, we are facing the biggest challenge, that is the assessment of long-term risk. So this is exactly the type of situation where we have to search for synergies between the public, the private, between private markets and public institutions. So it's definitely a big challenge. I think that PEPP does the job from this point of view. It sets a level stage, some level stage. But by the way, this will then require a lot of effort from consumers. Let's not forget financial literacy. Let's not forget the role of the industry. And bottom line, everybody has to play. Here we are playing in the same team. That's the great news, I guess.
Thank you, Professor. And my next question is to Martin. Because it was mentioned several times in our discussion about digital offer, and I want to hear your opinion. Will it have broad acceptance from the Pep Savers? What do you think about that?
Yeah, and I think we've raised in our discussion a number of the points of how we get discussion from how we get acceptance from savers. I think to be successful, the PEPP needs to sit within a broader culture of engaging with consumers on the need to save for the long term. And we can talk about specific issues, but also we need to look at the long-term savings infrastructure, which traditionally has not been a long-term equity savings culture. It's been very much a cash deposit or government bond savings culture, or a guaranteed insurance culture. So if you're going to change the mindset for something such as the PEPP, which even though it has risk mitigation strategies, is a first step for many people into European capital markets. I think it's important to engage with citizens at key points during their life and really explain how pension savings sits alongside their other priorities, such as short-term savings. I mean, we're really very, very conscious that during the pandemic, that's affecting everybody so badly, everyone is worried, everybody is frightened. We have seen precautionary savings really jump in most European countries, really quite considerably. So people are putting a lot of money aside. Saving isn't Europe's problem in many cases. You know, there's some cohorts I really appreciate who are just getting by, who can't afford to save. But at a global macroeconomic level, Europe has a lot of savings. But people tend to save in very secure, very liquid assets, or they may save for a house or flat. So it is, how do you add this extra pension savings into this? And so this is not, so I think we need a number of triggers which come in at various times in people's life, at key points, entry points of saying, when is it a good time to start saving for a PEPP? This may be the first time you open a bank account. You know, you have standardized savings advice with this. What are you going to do with your money? What are you going to do with your excess money? Are you creating a rainy day fund? Are you putting money aside for a house? Are you putting money aside for a pension? When you start work, you know, there are a lot of workplace benefits. And certainly, you know, we've seen interesting examples in a number of countries where employers can be subsidized in terms of reduction in employer social charges if they provide workplace advice, which is a really good way of getting into employees. And digital, but let's really not forget the digital expectation, because digital delivery has grown so much in the last in the last year. But let's not. I'm always really excited about the potential for digital delivery, but pure digital delivery can be tricky. And I sort of really appreciate the comment from my colleague from Amundi on this, that you need to have this mix. You need to have, in the European context, in most cases, you need to have this hybrid model. We're talking about trust. We're talking about putting your money away for 30 years. It's very different buying something off Amazon, which you're going to consume tomorrow, as opposed to putting your money away for 30, 40 years. You want to know that this brand name is still going to be around. Are they still going to have your money in 30, 40 years' time? So you want to see, you need to have that, many people need to have that contact. So service providers will need to provide this visual contact. Many people will be happy to do the administration, a lot of the accounts, the assessment online, but then they want to talk to a person, or they want to know that I want to be able to have a video conference call if you can't go into a branch, which increasingly many of us can't go into a branch at the moment in Europe because of the current situation. And we need to make it interactive as well. We talked a bit about the PEPP kit. One of the things I really like on that is that it is layered, but it also in the future, this should allow people to say, well, I don't really know what this term means. Can I just click and find out what it means? So you make this more make this a more interactive process. All of which goes to dealing with this issue of trust. Who stands behind the PEPP brand? So we really need to focus on making sure that it's engaging, that it is easy to use, but also that it is something that is very much trustworthy. And so that is, how do you somebody has to personify the trust, but also we need to be very clear on costs as well. People find percentages difficult. Being able to translate a percentage into a euro amount or another currency amount, local currency amount, is really important as well. It brings back, so what am I getting for my 500 euros a year I pay to people to manage my PEPP account, or whatever the figure is, whatever that 1% actually translates as is, what's the value that I get? So being able to answer those questions as well is really key. So it's a whole set of measures. I hope those are sort of a useful set of talking points and points to reflect on. Thank you.
Martin. And I see that in our audience we have representatives and experts from the Finnish Financial Supervision Commission. If they want to say a few words about our discussion. No? Then we continue to our next part of this session. But first, I want to thank to all our panelists for fruitful discussion. Once again, we are really glad to have you here. I think it's a really important issue that we must discuss in Bulgaria. And I hope that this is not our last meeting. And because the things are really dynamic on a PEPP standard, I suggest you, or I make you an invitation once again, let's say a year, not a year, but 6 months or 9 months, it depends how the things are going, to make another discussion on that for Bulgarian audience. Once again, thank you very much, and we were really glad to have you here.
Thank you.
Thank you.
Thank you.
Thank you.
And now we are continuing with the scientific reports. The first one is protection to mechanisms for customers of secondary and third pillar pension products. This report is written by Anne Wouters and Jorik van Zaden. And I want to present them. Anne is a PhD researcher in Utrecht University. Her research focuses on the questions whether principles from European customer law can resolve problems of second and third pillar pension consumers in the Netherlands, and comes from the field of pensions prior to her appointment at university, and worked in legal arithmetic at administrative capacity at several pension providers, a pension insurer, and Dutch tax and customs administrations. Together with Hans van Martin as a fellow, she has published several articles on the topic of PEPP. Jorik van Zanden is a PhD researcher at Utrecht University and consultant at Westerbrink. Prior to his employment at Utrecht University and Westerbrink, Jorik has a pension specialist and public policy specialist at Fidelity International. Before that, he worked as a priority advisor in the office of Rapporteur Sofia in the T-Welt, where he specially focused on the PEPP file. Together with the professor Hans van Marten, he wrote several articles on PEPP, including a chapter in the Handbook Your Pension Law. Welcome, both of you, and you have the floor.
Yes, thank you very much for that introduction. And thank you all for attending this conference. It's been an honor for me to speak here and to be surrounded by so many PEPP specialists. So, as announced, my name is Anne Wouters, and together with Jorik van Zanden, I will give a presentation on the topic of protection mechanisms for consumers in the PEPP. We will split the presentation in half. The first part will be presented by me. The second part will be presented by Jorik. Each part consists of 5 points. I will comment in a bit by introducing the chair and say a little bit about my research. Then I will continue by bringing forward the PEPP regulation and its relation with consumer law, European consumer law, and in particular with Article 169 of the Treaty on the Functioning of the European Union. That article contains principles, and Jorik will continue in the second part of the presentation by explaining how those principles are envisaged by the PEPP regulation. He will do this by focusing on the fee cap and portability, information requirements, complaints procedure. In the end, there will be a few concluding remarks, and I expect Jorik will say something about his research as well to begin his presentation with. So let's start it. Let's get started. So I work as a PhD researcher at the European Pension Law Chair at Utrecht University. And I chose to work for this chair because in my perspective, it has 2 unique features. The first feature is that in order to examine consumer protection or protection mechanisms in second and third pillar pensions in general, it takes a brand new perspective, namely the perspective of the person who takes off the product, the individual, the consumer. The second feature is that rather than testing this against Dutch frames of law, we chose to take on a European law perspective. For instance, my research, next slide please. For instance, my research, I am looking towards European consumer law for inspiration. As explained, I'm trying to establish whether it is possible to extract principles from European consumer law to cover omissions in existing protecting mechanisms in both second and third pillar pension products. So I'm looking to consumer law principles, and I'm looking to protection mechanisms in both pillars, and I'm trying to construct a frame that enables us to evaluate the current protection mechanisms and to see whether we can improve things. So that is a brand new angle, and it's very exciting. Well, I am very much at the beginning of my research. So at this point, sadly, I cannot give clues away if this approach works, and if it works, how it works. Jorik, next slide, please. But I can tell you something about the PEPP regulation, which is why I'm here today. Well, surrounded by PEPP specialists, you all know, it entered into force in the summer of 2019. And its aim was laying down uniform rules on the registration, manufacturing, distribution, and supervision of personal pension products that are distributed in the Union under the designation of PEPP. We all know this, but I want to emphasize on the fact that if you look closely to the PEPP regulation, to the wording, it is clear, it is crystal clear that it is about consumer protection. This follows from 2 points, perhaps no more, but at least 2 points. Within the Capital Market Union Action Plan, the PEPP regulation is the first initiative which is directly aimed at the consumer and not the financial provider. Another point is that if you look at the wording, an opt-in regime that establishes minimum consumer safeguards to protect consumers against overly pricey retirement products and empower them to make informed choices via inter alia information requirements and mandatory advice. So it is clear it is about consumer protection. Now, I want to go from consumer protection to consumer law. So how to establish that correlation? Next slide, please. Thank you. I'll try to do that in 3 points. I'll start by saying that if you look at the legislative history, about the PEPP regulation, it is not set up, it is not drafted along the lines of consumer law. So let's be clear about that. Regardless, that doesn't mean that the principles of consumer law are completely absent in the regulation. Jorik will tell you more about that in the second part. To close my point, the third point I want to bring forward to establish the correlation is that the PEPP is a European instrument, so it makes sense to look for inspiration in European principles of consumer law. An example of such a principle is Article 38, my apologies, of the Charter of Fundamental Rights, which is about consumer protection. But another example is Article 169 of the Treaty on the Functioning of the European Union, which is about consumers. And it reads as follows, so please read with me. In order to promote the interests of consumers and to ensure a high level of consumer protection, the Union shall contribute to protecting the health of consumers, protecting the safety of consumers, protecting the economic interests of consumers, but also to promote their rights to be informed and educated and to organize themselves in order to safeguard their interests. So we have 5 principles in this article. So the next question that comes to mind is, how are those 5 principles reflected in the PEPP regulation? Jorik, can you tell us something about that?
I sure hope so. So thank you very much for this introduction, Anne. Currently, I'm looking at only my slides, so I cannot see anything else. So if there are any questions, would you, Anne, please attend me to those to to say
Yes.
that there are any questions. Thank you.
Go ahead.
So, as promised, I should tell very short, a little bit about my research. Like Anne, I take a consumer perspective on pensions, both on the second and the third pillar. And I do so from a legal comparative point of view. So I am looking at a number of countries and try and identify mechanisms that protect the consumer. That was in a nutshell my research. I am more than happy to elaborate on that, but let's dive into PEPP for today. When talking about PEPP, basically two things come up. First of all, it needs to be a safe product that's trusted by the consumer. I've heard this resonate a lot during the talks of yesterday and today as well. But for the PEPP to work, people need to buy it. On exactly the same notion, it has to be offered for consumers to buy it. So it has to be safe, provide value for money, it must be trusted. And in that sense, it's more than just a retail financial product. On the other hand, in fact, it is a consumer product, which needs to be viable, profitable, and easy to market. So in that sense, there is a bit of a paradox between consumer access and consumer safety. Not necessarily a paradox, but it does make for a nice acronym, the PEPP. But there is tension between the two of them. So if we have a look from Article 169, I think it is very obvious that there is a very hefty focus on informational requirements. One of the key aspects of European consumer law. Pre-contractual, during the contract, pre-retirement, as well as during decumulation. Like other speakers, I'm very happy that this can be done digitally. As well, I am myself a millennial, and so we do like to look it up online instead of going through the paperwork. And also, this informational requirements focuses on education as well. I think PEPP and the Mortgage Directive are the only two legislative acts that mention financial literacy and education, besides, of course, the founding acts of the ESAs. Because if someone wants to make a good decision on which PEPP to buy, which I will go into at economic interests, it's very important to know what someone needs. You can design the best PEPP there is, but for example, if you don't have any fund to purchase an individual pension product, the best product is still not the right choice. So perhaps even from that line of reasoning, besides the information requirements, there's also a very strict rule on advice. The advice is not only personal, so it has to be personalized, but it also has to take into account other retirement provisions, which means that this is probably one of the most strict ways of providing advice currently out there for a financial product. Looking at, so yes, I would say it scores very well on information requirements. Looking at the economic interests, that's also something that has been very, very strictly regulated. Looking at the cap on the costs and the fees of 1%, which is actually based on the UK system of having a fee cap in their occupational pensions of 0.75, if I'm not mistaken. I'm sure Martin Parks is able to correct me if I'm wrong. As well as the limited investment choice. So you can either have a PEPP based on for the default option on a guarantee or on a life cycle. In the original Commission proposal, it just stated capital protection. But well, in the political process, it was needed to clarify a little bit more. So that's the investment choice. but also the options under a PEPP are limited. You cannot have 12 different options, but I believe it's limited to 6. Again, to protect the saver from too much choice. Because as we know from behavioral finance, too much choice is perhaps as bad as too little choice. And then there's also a right to switch, a very, well, I would say very much consumer friendly. If a provider underperforms, the saver is able to switch. I would say that, well, the PEPP scores very high on the protection of economic interests as well. Even though the PEPP is an individual product, or at least that's what we have to say, there are some organizational aspects, some collective aspects in it as well. There's a complaints procedure, which can be lodged collectively as well as individually. Furthermore, not only at the regulator of the provider, but also at the regulator of the member state of residence. And we have this funny exception for the individual aspect of the PEPP, and that's the Pep Savers Association. So a Pep Savers Association, which is a collective, is able to purchase a PEPP on behalf of its members, which of course is very much in the interest of the consumer, as well, a form of collectiveness might also increase the bargaining power. Right to organize, most definitely very well represented in the PEPP, especially being it an individual third pillar product. So those aspects, yes, they're clearly there. But, and I mentioned it before, there is a form of a paradox. So if we ask ourselves the questions, why do we impose limitations on costs, investment strategies, give PEPP savers the right to switch, while informing them every step of the way, to ensure a value for money, safe product, because it's a pension product. People need to trust the product. Makes sense in my opinion. Another question is, why does someone need advice? Well, to protect against purchasing a faulty, unsuitable product, or select the best option. But I think from a regulatory point of view, it's probably more about protection. So if we look at the recitals of the PEPP regulation, which describes why advice should be given, it's due to the long-term retirement nature, the individual demands and needs, and limited redeemability. And then there's something that strikes me as a little bit peculiar. Advice should particularly aim at informing the PEPP saver about the features of the investment options, which I highlighted in my earlier paragraph as well, because they're all subject to very strict limitations and regulations. The level of capital protection, which is again very strictly regulated, and the forms of outpayments. So basically, we are creating, on the one hand, an extremely safe product, while on the other hand, also setting up such a strict advice procedure that, well, might be a little bit too much love. While the product scores a AAA in consumer protection, there is a band you might know, Queen, who said, "Too much love will kill you every time." And I think that is something to be wary of. If a product is very strictly regulated, the consumer is informed, there's a right to switch, there's a complaints procedure set up. Why are we so strict on advice, and why do we include it in the cost cap? It's balance. I have answers, but for both sides, because that's, I think, in essence, of course, the legal profession. It's Europe's first product label. Of course, UCITS only started well, as Martin said, at like use 3. This is PEPP 1. It's a pension product, and pensions are deeply cultural. They're considered to be an essential part of reaching retirement. And if we do the first version wrong, that weighs way heavier for the consumer than 10 rights. On the other hand, it has to be offered for it to work. So we also need to put on the market a PEPP. And it's a pension product. So there's a limit to how much regulation you can put in place. I once heard the phrase, I forgot who said it, but that the parliament was trying to create a socialist capitalistic product. I left the other one intentionally blank because if you do not offer anything, you cannot do it wrong, or you can do it right. So in conclusion, we do have a European Union approved label for financial products, which scores incredibly high in consumer protection. It might be a little bit overkill. In my personal opinion, I do believe it can establish best practices. It can act as an inspiration, and we need to push forward to PEPP 2.0. Yesterday, it was mentioned that it takes time, indeed, but the fact that we have this product here, which we now all consider to be a fact, it was down in the negotiations so many times that I think that alone is already a sign that we need a PEPP. We need to fuel the capital markets union. Yeah, and I think that with this incredible instrument of consumer protection, that is something we can accomplish. I'm now going to press escape. I might be a millennial, but I do know very little about how this works. So let's see if everything, there we are. So this was my presentation, or our presentation. Sorry, Anne. Are there any questions?
Thank you very much, Anne. Thank you very much, Yorick. I'm really glad that the fans of the Queen are all over the world. A really nice and interesting presentation. Thank you once again. Our next participant is Dr. Elroy Haddad, Associate Member in the Faculty of Engineering at the Shimon College of Engineering, Israel. I hope that I pronounced the right name of the college. You can switch your microphone.
I say, yes, you did it right. Very well.
So you have the floor.
Okay.
Your presentation, let's say that is in the field of pension reforms and capital market development, evidence from Israel. So it's your turn now.
Okay, thank you very much. So I'm Dr. Elroy Haddad. I'm from Shamun College of Engineering. Sorry, it's not the wrong presentation. One moment. This is the right one. Okay, thank you very much for the invitation. It has been a wonderful session, and I really enjoyed the conference. And thank you very much once again for the invitation. My name is Dr. Elroy Haddad. I'm from Shamun College of Engineering from Israel. And I'm going to show you some, this presentation is about pension reforms and its effect on capital markets. I'm going to focus on evidences of the rise of the deepness and the efficiency of the corporate bonds market, the local corporate bonds market. So here's a short background. In the past 15 years, there have been significant changes in the Israeli debt market efficiency and deepness. we see an evidences of a significant increase in the market capital and an increase in the average daily trading volume, a major rise in the number of size of corporate bond issues and the number and the size, a major rise in liquidity. And we believe that all of these trends were mainly driven by several reforms relating to the activity of corporate bonds market, and specifically to the activity of institutional investors in the financial systems as a result of several pension reforms that the Israeli government did. So in historical perspective, the financial market in Israel was mainly controlled by the Israeli government. The Israeli government took a very active role in the allocation of resources and savings. And actually, the government issued subsidized non-tradable corporate bonds to other pension savings, like pension, also including pension funds, insurance companies, etc. And these pension savings were obligated to invest most of their funds in these bonds. We're talking about above 90% of the funds were obligated to invest in the subsidized non-tradable treasury bonds. And moreover, the financial system was really dominated, was strongly dominated by highly concentrated banking system. So the banks actually controlled most of the funds of the credit of the business sector, and the banks also controlled the capital market through other subsidiaries like mutual funds and provident funds. And the situation was very bad. The situation was very weak, and it was the situation limited the development of corporate bonds market. And so this situation led to several reforms that initiated a series of reforms that of the financial activity. And these reforms were designed to promote the development of capital markets, specifically to local corporate bonds market. So the pension reforms of in 2003 there was a major pension reform in Israel. The pension reform led to a structural change in the pension institutional investors. Like the key highlights of the reform was that the new regulations enable the pension savings to invest most of their funds in the capital market, unlike the situation before that were obligated to invest at least 90% and above. Some of them are above 90% of the funds in non-tradable treasury bonds. The new regulation enabled the pension savings to invest their funds in the capital market. So, and other highlight that the government have also gradually reduced the issuance of treasury bonds to pension savings. The reduction was in order to increase competition in the market and increase competition between pension providers. And other highlight that the pension reform also included the transfer of deficit pension funds to be sold to another professional and private insurance companies and brokers. So there was a major rise in proficiency as in the activity of them in the market as a result of this reform. In 2004, the government also initiated an income tax regulation. The income tax regulation gave the pension savings and income tax exemptions to pension savings for both, also for the employees and also for the employers. And this has been this resulted in an increase in pension savings in general. And the last one, not the last, but not the least, the Bahar reform in 2005. The Bahar reform was a major change in Israeli financial system because it has reduced the banking system dominance. The Bahar reform forced the banks to separate the ownership and management of mutual funds and provident funds to private institutions, and this resulted a rise in competition in the capital market in general and also in the pension savings private institutions in specifically. So the first of the sale of the fund to private institutions have increased the competition and also increased the efficiency in the market. The Baha reform also, there has been another several highlights of the Baha reforms, like the establishment of separate trading system for institutional investors, etc. And in 2008, the government also initiated the right to switch reform. Because the right to switch reform enabled pension savers to switch providers and to choose other different investment options, like what the PEPP actually say. And there was no fine and no tax event if the investor switch between pension provider. There is no fine and no tax event. And this reform have also increased the competition among pension providers and increased the pension funds in general, the savings funds in general. So all of these changes led to a major increase in institutional investors' fund savings. The institutional fund savings have been increased, and also the competition have been increased. But the 2003 reform of the pension system have grown. Most of the funds of the pension providers were invested in the corporate bond market sector, which increased the liquidity and efficiency of the market. So the next figure we see here, for example, at the beginning of the era of the reforms in 2002, 3, and 4, there was a very weak investments of institutional investors in the corporate bonds market. We see here the institutional investors' investments in 1 million new Israeli shekels. Before the reform, we talk about maybe 10 billion shekels, 15 billion shekels, 20 billion shekels, which is about equivalent to $5 million. That's it. And after the reform, there was a sharp rise in corporate bond investment. And we talk about in 2007, we talk about $80 billion. And also the percentage holdings of the pension funds where investment have been increasingly rise. We talk about from about 3% before the era of the reforms to about 12, 13, 15% after the era of the reforms. This figure shows the number of issues and size in tradable corporate bonds market. We see here before the era of the reforms, the pension reforms and the Baha reform, we talk about maybe 15, 12, 17 issues a year. Okay, this is a number of issues per year in million new Israeli shekels. And after the reform, we see a sharp rise in the number of issues, and also a rise in the size of the issue. We talk about from merely 5 million new Israeli shekels or 10 new Israeli shekels. Talk about now about over 60 billion new Israeli shekels. And this is actually the motivation for the study, because we would like to study the impact of the latest reforms of the Israeli market structure over the debt market development, over the liquidity and the efficiency of the corporate bonds market. And the focus is on the trading activity within the corporate bonds sector. And we believe that the Israeli case may also guide other policymakers in other countries, specifically in European countries, with inefficient debt market in order to promote debt market efficiency. So the methodology that we use, we studied the liquidity and the volume of the Israeli debt market in general. We use daily trading transactions of all government and corporate bonds, but rated A or above by the definition of the Bank of Israel and the Moody's. And the time period that we covered from January 2004, which is the beginning of the era of the reforms, until January 2014, we talk about a decade. We collect about 340,000 daily records and 105,000 records of 224 government bonds and about 230,000 corporate bonds issued by 67 companies. So we specifically would like to measure the efficiency in the market. So we use several liquidity proxies. We use the Amihud e-liquidity measure. The Amihud e-liquidity measure actually relates the price impact of trades to trading volume. The e-liquidity factor, we call it the e-liquidity factor. Let's see how it's built up. The e-liquidity factor actually is the average of the return R, the return of the bond I in month T, divided by the volume of the trading. So actually it says if there is no liquidity in the market, there is illiquidity in the market, 1 million new Israeli shekel trading volume should impact the return of the bond. So if there is if there is a rise in the volume, it should impact the return. So the illiquidity factor should go up. But if there is a liquidity and efficiency in the market, the 1 million volume dollar transaction should not impact at all at the return of the bond. So the illiquidity factor should go down. Okay, the illiquidity factor is very strong measure in finance that we use. The other factor that we use, I'm not going to show you all the regression results. I'm going to focus on the main key findings. Okay, the percentage zero trading days is measured also by Chen, Lesmond, and Dway. It is based on the number of days in which no change in bond price occurred. So it's actually measured. It measures also the liquidity, because if the number of days there is no change in bond price occurred, it is related to that. It means that the bonds was not traded at all. So if the percentage zeros is high, it means indicates that there is no liquidity and no efficiency in the market. So we would like to compare the result that we got to Dick Nielsen, Feldharter, and Lando, the very nice paper that analyzed the liquidity of US corporate bonds during 2005 and 2009. The comparison, we believe that the comparison indicates about the liquidity in Israel, because we assume that the US corporate bonds market, the OTC market, over-the-counter corporate bonds market, is the largest and the most efficient and the most liquid market in the world. So, like Dick Nielsen, we analyzed the bond spreads before and after the global financial crisis, and we would like to compare the results, the illiquidity factor and the percentage zeros, to the results of the Dick Nielsen. So here is some results, interesting results. We see here the average daily trading volume in million new Israeli shekels of government bonds in red and corporate bonds in gray. You see here before, at the beginning of the era of the reforms, we see here very weak corporate bond market. We talk about maybe, if I remember, that's 40 million new Israeli shekel per year. Talk about $10 million. That's equivalency. And after the reforms, we see here a major rise in corporate bond daily trading volume, average daily trading volume. Sorry, also for the government bond, but specifically on the corporate bond market. This figure shows the average yearly volume of Amihud's illiquidity measure, and also the percentage zero trading volume. The percentage zeros of tradable corporate bond market, only tradable corporate bond market in Israel. So they see here also in at the beginning of the era of the reforms, 2004, 3, 4, and 5, was the number of zero trading days here in blue. The number of zero trading days is above almost 60%. It means 60% of the time, in average, 60% of the time, most of the corporate bonds market in Israel were not traded at all. And so after the reforms, we see and the number of size of tradable corporate bonds in the market, we see a major drop in zero trading days. We talk about the late of the year of 2013, we talk about 5%, even less. And if we focus on Amihud's illiquidity factor, we see here that the Amihud illiquidity factor, I say it again, it is a price impact factor. So it measures the change of the return per percentage change per 1 million new Israeli shekels. Okay, and we see here that we talk about maybe 2.5 basis points before the era of the reforms. The rise between 2007, 8, and 9 is actually related to the subprime crisis, which had effect all over the world. But after the subprime crisis, we see a major drop in Amihud's liquidity factor. We talk about in late 2013, we talk about less than 1 basis point price impact. So the results, for a summary, the results we show is dramatic rise in trading activity and liquidity in corporate bond market. We find an overall decline in average illiquidity factor from 0.02 in 2004 to merely less than 0.01 in 2013. So it means that it reflects an average price impact of merely 1% per new Israeli, 1 million new Israeli transactions, which is also equivalent to about $300,000, $250,000–300,000. And the median illiquidity drops from 0.013 in the pre-crisis period to a mere of 0.02 in the post-crisis period. And the median illiquidity in Israeli corporate bond market is even lower if we compare the result to the median illiquidity factor in the US corporate bond market, as reported by Dick Nissen et al. And the median illiquidity in Israel is even lower compared to the median illiquidity in US market. So in general, it means that the liquidity factor in Israel is better than the US. We also find a significant decline in the mean percentage of non-trading days, zero trading days, months before and after the subprime crisis. So also for the government bonds and also for the corporate bonds. Median zero trading days drops from the median, okay? The median drops from 22% in the pre-crisis period to 0.5% only in 2013. For comparison, if you compare the results to the US market, the Dick Nielsen report a median zero trading days of 60%. 60% of the time, the corporate bonds in OTC markets, over-the-counter market in US, were not traded. And this measure, we believe that this measure also highlights the activity of the Israeli corporate bond market in general. I have left 3 minutes. And so in conclusion, we show evidence of major developments in the Israeli government and corporate bond market depth and also the liquidity. With the key findings show dramatic improvement in liquidity practice corporate bond sector. Even if you compare the result to the US OTC market, which is the biggest and the strongest and the deepest market in the world. And these findings also are associated to, we believe that these findings are associated to gradual changes in the financial system as a result of the reforms, including the pension reforms, the tax insurance, the tax reform, and the buffer reform. These reforms have boosted the local savings and they actually promoted the debt market development in general. So We believe that the Israeli case also may suggest other policymakers in countries, in European countries specifically, if we talk about the PEPP, and we believe that the countries with inefficient debt market development also strive for better regulation in pension savings and the market structure at all in order to promote the debt market efficiency. So in general, I believe that the PEPP contributes to these suggestions because they raise the competition between pension providers, and the pension providers who should strive for better trading and for better excellency in trading as institutional investors that may affect also the corporate bond market in general. I would like to speak about the stock market, but I have a limited time. So this is the last slide. So thank you very much for the invitation once again. And I'm open for questions from the crowd.
Thank you, Elroy. I suggest the questions to be at the end of the panel, which will be around after 2 presentations. So our next presentation is coming from Tanya Genova, which is a PhD candidate in VUZF University. And that after that will be Associate Professor Stanislav Dimitrov. But let's first give the floor to Tanya. Tanya, can you hear me?
Yes, I can hear you.
So,
do you hear me?
Yeah, the floor is yours.
Perfect. So first of all, thank you for giving me the opportunity to be part of this very interesting conference. I have taken notes and many insights from the other participants, and I was considering exactly how to put my topic within this one. It is not exactly related to, or let's say, not that direct to the bigger concept of PEPP, but I see a lot of synergies and touch points, and I hope that it will be also interesting for you. So my topic is, first of all, a little bit about myself. So I'm Tanya Genova. I'm being part of the university for the last 2 years, and I'm working in the sphere of payments and finance. This is why I thought this topic will be also relevant for you. So I would first tell you a little bit about open banking, what open banking is, how it works, and then in particular, I will look at some use cases that are for the sphere of finance, and in the broader context, they touch point on fintech, increased competition, the digitalization, the changed customer needs, all of the let's say features of the temporary reality that we all discussed with the focus of PEPP as well. Okay, so we may start with the first slide, please. So what is open banking? So first of all, open banking, this is a regulation that requires the banks to allow their customers to securely share their transactional data with approved third parties. So what this means, in the broader concept of PSD2, the payment directive, we know that one of the main purposes of it is increased competition, answering and regulating the fintechs, the need of digitalization, and the changed customer needs. So open banking actually appears within this context. And this is a regulation that specifically triggers the banking industry and requires them to provide a secure way to share this information with the so-called third-party providers. So what the third-party providers can see, and what kind of data they can take advantage of. This is generally the customer account data, and this provides opportunities for different generating new products, services, reducing costs and increasing profits in many different spheres, also in insurance. And also the second, let's say, big pillar, it's the opportunity for third-party providers to initiate payments. This is very, let's say, summarized overview on what open banking is. And I will go into more details in the next slides. Here, just as a background, I would like to say that generally, from a regulational perspective, there are different groups, for the example, that regulates the open banking. So there is the UK group, so OBI, then we in Bulgaria, we are part of the Berlin group. So ours is based on, so our Bistra is based on the Berlin group. There is also a Polish group and an Italian group. So these groups, they regulate, they put the standard over which the open banking is actually realized. To summarize here, the main touch points and the main, let's say, synergies that we will see later on in the presentation are coming from the need of answering better the customer needs in terms of safety, in terms of accessibility, in terms of value for money. So those are quite important features in each and every industry from the perspective of customer expectations, as well for the personal pension products on the one side, and also to increase, so to answer the reality of increased competition and the domination in some spheres of the fintechs. So we can move to the next slide. Thank you. Actually, sorry, we shall come back to the previous one. Thanks. So how does open banking work? Actually, this is, with one word, with one sentence, this is done via APIs, and the application programming interfaces actually make possible for the software at one company to access information of the software of the other company. So why we use APIs in open banking? Because they're secure, they're considered a secure enough option, and they give the opportunity for applications to share data without actually sharing the account credentials of each cardholder. For talking more about the APIs, I would say that actually this is a new business for the banking industry as well, because as we may see, as we will see further on, enabling the different participants to share information, we actually generate a new product that is priced over the API calls. So later on, I may go into more details if you may be interested in that. So we move to the next slide, please. Thank you. So how does open banking works? Generally speaking, there are two big participants. So these are the banks, the account servicing institutions, and e-money institutions, as well as credit unions. And then on the other side will be the so-called third-party providers. As I mentioned, the main two pillars of the use of the open banking, they are also reflected in the two general type of third-party providers, and these are the PISPs, so Payment Initiation Service Providers, and then AISPs, Account Information Service Providers. Those third-party providers are enabled to enter into the market via, let's say, reduced eased regulation from the national authorities. So in the case of Bulgaria, yes, there is a registration, but for the PISPs, it is very easy and enlightened and does not require any guarantees, while for the AISPs, a bank guarantee will be required, and also certain amounts of capital so that the license can be taken from BNB. How the flow works? Actually, the banks provide these interfaces and allow those already registered and licensed third-party providers to connect via API. And then the role of the bank is, of course, to monitor and prevent fraud. And they, for that, they needed to upgrade their systems so that they can answer first the PSD2 regulation, and then also to be capable of sustaining those protocols so that all banks can connect via these standardized protocols of the bank to their databases. On the other side, the PSPs, the third-party providers, connecting through these APIs, they can provide to the end consumers two main type of services. The one will be only analyzing the data, accessing it through these API calls, and providing, let's say, analytics, insights over the customer behavior, over his spending behavior, and you will see later on in the presentation how this new feature generate actually a lot of new services, a lot of new products, a lot of new revenue streams that can be applied in each and every industry almost. For the account information service providers, actually what they do, they transfer this information, and apart from analytics and alerts that they can do, they can initiate on behalf of the end consumer, after taking the consent of the consumer, payments on his behalf. So as you of course may see, this generates a lot of new products again, and it also brings to automation of businesses, reduction of costs, speed to market, then also increasing dramatically the UX of the end consumer and servicing the end consumer in a different way. Then we can now move to the next slide. So I will just dwell a little bit more on what is allowed under the PSD2 and open banking regulation as information that can be accessed. So the mandate, so part of the information is mandated, and this is in the scope of the open banking regulation. This is the end consumer name, the current balance of the end consumer, the account name, and the transactional history of the spending within the last 3 months. So this is mandated. What does this mean? Is that using the regular API call, all the banks, all the financial institutions, e-money institutions are obliged, after a third-party provider is licensed and the end consumer has provided consent for taking his data, the bank and the financial institution is obliged to transfer the data that contains from end user name, current balance, account name, and transactional history. However, as I mentioned at the beginning, this is a whole new industry, giving a new perspective towards doing business and definitely answering the digitalization requirements of our reality. So it gives also opportunity for banks to monetize this process. So out of scope of the directive, but still available via these API calls are the so-called premium APIs, which we already see this in the most developed markets, which are UK, followed by Poland, but definitely UK, where the banks have already is already monetizing the data. So they're adding also the opportunity to transfer premium information such as user address, specific account details, non-payment products, user age, and also past defaults and past frauds. I think that in relation to the particular use cases and how we can use open banking here in Bulgaria, we will be more interested for the combination of those two in-scope and out-of-scope data elements, because using all this data, we actually enable the automation and digitalization of many products, and it really applies very well for insurance. We may move to the next page. Okay, so by the way, if you have any questions, please feel free to ask at the moment, or I can answer them after I finish the presentation. Before I go to the specific use cases that I have selected in the broader concept of open banking, I would like to summarize the following. The banking industry, as well as the insurance industry, is really challenged nowadays by the new technology, by the new payment platforms, by fintech, and really increased pressure is put over customizing and moving the traditional products into a new offering that answers the increased need for time, safety, speed, value added, value for money of the end consumers. This is why open banking provides huge opportunities of how the traditional business may be done in the future, so that it triggers all these challenges that we are facing. It sits on the one side on big data, so utilizing the pure data that the banking industry is having. On the other side, it also gives insight for behavioral data, and this is also related with artificial intelligence and different insights management platforms that we are seeing in the new reality, that using in a regulated way that provides protection to the end consumer, the data that the end consumer owns, provide us the opportunity to answer the reality and to answer the need of this product offering in a new way, in a personalized way for the end consumer, in a timely manner. For Bulgaria, there is still few companies that have been registered as third-party providers. The leading market is UK, so the open banking operates there almost 2 years, and one more feature of open banking is that this is cross-border. So there is no border for participants from UK to penetrate our market. Well, I'm saying this because what we have seen on our market is that still the awareness of what open banking is and what opportunities it brings is really low, and that most probably international participants and cross-border countries will be the first to occupy this environment. Same works for fintechs. So this is why it is the right time to see like how this open banking standard and best practices can be applied on our market for particular industries, for particular products, and the sooner this is seen and realized, the better the offering and the speed to market will be. So now I will go to the next slide, and I will tell you more about best practices already seen, already monitored in the UK market, mainly for open banking in insurance sector. So I'll start with the first one because the topic is quite broad, and we may spend a lot of time into digging deeper into the product itself, into the, let's say, the mobile application that provides the particular service, or on the company, insurance company that provides it. I have tried to really just summarize the main use cases, and then of course, if you would be interested, we can discuss in more particular the application of all of this in reality with names and participants. So the first use will be related to actually generating the opportunity for new products. As we mentioned, the regulation also has its benefits, but also put some new challenges. So this new type of cyber insurance products will be needed to address exactly the needs of the third-party providers to answer the regulation and to provide the professional insurance and guarantee to the authorities so that they can cover their liability as being account service providers. Not as being account service providers, sorry, but as being account AISPs and PSPs. So from this perspective, the insurance industry can create, and it is already on the market, such products that answers exactly those needs. So for this particular use case, I would say it's more B2B, it's not that B2C, but it's in the scope of insurance. The next one, and I think it will be more interesting to you, this is the better deal engines. This is how it is called. So from the one side, PSD provides third-party access to payment accounts information, and this data that, as we discussed, sit on the big data of the banks can be mined, and using or not using artificial intelligence, it can bring relevant insights on the customer behavior. And this information is really key so that we can improve our product offering. How this works in practice. For example, at the moment, if you're applying for a loan or for insurance, the profile of the customer is being done based on certain KPIs, and they're usually sitting on the official information that the customer provides, like what my salary is, how much funds I have, what is my social benefit, etc. So this creates a lot of turbulences and missed opportunities and revenues for those part of the end consumers who are, let's say, self-employed or who have more funds that then it's visible in their social benefits records or their salary, right? So now having access to the spending behavior of the customer, because the criteria, as I mentioned, is 3 months historical data. So having this information plus the information of the premium APIs, which would be, let's say, the address, the age of the customer, you will have much more behavioral and data insights so that you can achieve a better risk profile of the customer, and hence the pricing of the insurance product can be made more attractive for the end consumer on the one side, and also this will bring reduced cost for the analysis and the risk management itself from the perspective of the company. Then the next usage, and that is also seen in different insurance companies, is the improved personalized advice. So I think it correlates, it brings a value also to what have been already discussed for the need of better advice for the end consumer. So transparent and information-based choice of the end consumer to choose the right product for pension, for example, for pension plan, for example. So again, apart from mining the data coming from the financial institutions through open banking, actually we can use we can use artificial intelligence again or not, or different insight platforms, and generate not only better risk profile of the customer, but give advice to them how to use better their funds, how to invest better in what. This can be done, of course, by analyzing their spending behavior. Where do I spend my money? How often? Do I have any, let's say, mortgage? Do I buy property? So all this data, it gives the behavioral profile, and you can easily tailor the end consumer offer. Okay, then optimizing claims management. This is related to the fact that open banking gives opportunity for automation and cost reduction. How? This is mostly relevant for online sales, because, for example, I'll give example to showcase this one. If you have an insurance, travel insurance, and then you're losing your luggage at the airport, then in order to take advantage of your insurance, you need to provide certain receipts, certain documents that prove what was in the luggage, right? So now with open banking, you can easily do this only in a digital way, because having access to the bank transcripts of the customer, again, after the consent of the customer, you don't need to ask him to keep the receipts, to take a picture of the receipts, to send them via courier or whatever the process may be, but you can directly, via one API code, check where and what he bought, and also reduce the rate of fraud, because it is also possible. I can collect the receipts of my friends and then present them for reimbursement, while if you check directly the account of the customer, you will have a clear proof that the real item was bought. Okay, so we can move to the next one. So, up-to-date customer records. Up-to-date customer records. To put it short, this is more or less related to utilization of the banking information about the customer that is held in the banks. So this particular use case is actually using both open banking and PSD too, so it is regulated by both. Sometimes when you're onboarding a new customer, or when you need to keep track of the valid customer information. So all this data is part of the premium API part of the open banking, and the third-party provider can take use of it. In this way, he would dramatically increase the use case of the end consumer, because he would not be required to every time fill in the data, but you may have it pre-filled and just verify this. You also have the opportunity to keep it updated. So this definitely increased the conversion ratios, because we know very well that it works for both payments, where the abandon rate increased dramatically when we ask the customer to fill in a lot of information about himself before he can conclude a purchase. So hence, so same works for insurance. The moment you're onboarding a customer and you need to do KYC, then the most information you can have verified and pre-filled in, the better the customer experience and the higher the conversion rates. The next one, actually, what I already mentioned, relates to the last one, digital identity verification. And in reality, how does the flow work? So if an insurance company is also a third-party provider, it can, in its online offering, it can verify to the end consumer the option to verify via open banking. So this is kind of a button that the end consumer can press, and then it triggers an API call from the third-party provider to the different banks that the customer has account with, or a particular bank. Of course, putting in brackets, the consent of the customer is required here. So after the customer has agreed that his data may be taken from the bank, only by pressing verify by open banking, the application can verify his identity, and this would diminish and almost decrease the need of the customer to bring, for example, his ID, to make a picture of it, to come face to face when it is when the process is still not digitalized, and the major data about the personality of the person will be pre-filled, and not only pre-filled, like, so not only identified but also verified. This is extremely important. And then last but not least is the expanding service proposition, the second one on this page. So here we speak more about the opportunity for the insurance company to offer new services to their end consumers. For example, on the one side, I'm seeing your behavior. I see how what your spending is. I see your broader incomes. Doesn't matter coming from salaries, from rent, or I don't know from where. So I see your total fund availability, and also, as I said, your spending. So I may offer you, if I'm also payment initiation institution, so this type of third-party provider, I can offer you that part of your salary is immediately going each month to some pension product, or to some child's insurance, or products that are dedicated to children, or for elderly care. Doesn't matter what the product may be. Here, the idea is that being a third-party provider that also can initiate payments using open banking, it gives you opportunity to move funds from one account to another on behalf of the customer, providing a UX to the customer with only one button to really do this and to subscribe for this service. As I mentioned, the topic is quite broad, and actually I was trying to find real use cases that are related to the insurance industry, and that can be just a showcase. Just give the process and the broader idea of how open banking can be applied in here, so that we can see that in the particular context of PEPP, we can use a lot of these KPIs and a lot of these functionalities to also tailor and our offer, and to also digitalize and optimize the businesses. And in a summary, I will just bring down what are the main benefits that I have seen in relation to our topic. And this is the opportunity for new products.
Hello, everyone again. Now, because sorry that we interrupting you, Tane, but you pass the schedule with more than 20 minutes, so it is not allowed to do this on such conference. Thank you for your presentation again, and now I want to continue with Professor Stanislav Dimitrov, which is Professor Dimitrov is head of VUZF Lab's Insurance and Pension Research Department. He is also the head of the Financial Department, Department of Finance in VUZF University, and lecturer of Financial Management, Financial Budgeting and Planning Management of Pension Companies. He is also Executive Director of pension company Saglasie. And here is the time to say that Professor Stanislav Dimitrov is the main engine sitting behind this conference, and I want to thank him on behalf of my colleagues and behalf of the university for the perfect work he doing in according to this conference and according to his presentation in the university. Once again, thank you, Professor Dimitrov, and now you have the floor.
Thank you, Radustin. I'm happy that we have very productive discussions till now. Again, I want to bring back your attention to the savers, to the potential savers, and I want to present the VUZF study among the potential savers about their attitude towards PEPP, towards retirement products. I have pre-recorded the presentation.
Hi to everybody. I have to present the results of the study among potential savers. The VUZF University conducted a study during the last month. The respondents are more than 300 persons. We asked 12 questions, and some of the results are presented here. First question: what do savers want? We see that there is clear majority of respondents who expect 80% target replacement ratio, more than 60% of the people. Here relates the principle, the more the better. We see that the 13% who expect 100% replacement ratio and more. What do savers need? To the question, do you feel that you need to save for voluntary pension? We see that 84% feel that they need to save for voluntary pension. This is good news for the PEPP providers. 84%. Half of them are saying that the pay-as-you-go pension will not be enough, and the other half are saying that they prefer to dispose with personal assets at retirement. Which provider has the greatest trust for retirement product? Here, the pension institutions has the highest score, more than 40%. Second are the banks with 29, and almost 19. Third is the life insurance companies. Of course, the answer of this question depends on the country specifics of the current markets for retirement products. Readiness to pay for voluntary pension. Which size of contribution the person is ready to pay as part of the monthly income. Here also we have clear majority, 62%, stating that between 5 and 10% of the monthly income contributions, they are ready to pay for voluntary pension. We can see that more than 13% are ready to pay more than 10% of their income. One question which is very important, whether the tax reliefs can be factors in buying PEPP and retirement products. More than 67% are saying that the tax relief could be a factor. 38 are saying that the safe tax is of great importance, and look, 27% of the respondents are saying that when we have tax reliefs, this is a sign that the state encourages the saving. When we look the risk attitude, which is the preferred investment portfolio for personal pensions, I think the result is not a surprise. Later we have two surprises. For the investment portfolio, 69% of the people the preferred option is balanced portfolio, but you can see that 7% have attitude to high risk in order to achieve high income. This is some kind of brave savers. This result is something that tells us a lot. What is the most important for you when you choose product from pension saving? 67% are saying that security is the most important. Second place comes for investment return. So again, this result corresponds to this brave group. Here, they're 22%. I think there is clear two groups. One which prefer security, and the other one which can opt for higher risk in search for higher investment return. This result is the first surprise for me. The question was whether the PEPP will increase the retirement savings, and we have almost divided. 50% are saying yes, 50% are saying no. It is interesting the motives behind these answers. 35% are saying yes because this is safe product. I think this relates to the security, the previous result, and 15% are saying because it is attractive product, it will increase the savings. Again, it relates to the cost, to the investment return. And 28% are saying that because of lack of trust, there will be small demand. Again, we are coming to the very important question, the trust. And 22% are saying that because of low income, the demand of PEPP will be low. One question which relates to the preferred outpayment in retirement. Most of the people points the preferred option combination between lump sum and life annuity, 51%. And I think this is the best solution. Most of us expect to have to receive something as a lump sum at retirement and to be secured with life annuity. But this option, this combination, requires accumulation of a good sum. So accumulation of a good size of a capital. So we have to start to save now if we are still not doing this. This is the second surprise for me. On the question, will you buy PEPP through internet? Again, the people are almost divided. 51% are saying yes, and 59, so 41 saying yes, and 59 are saying no. Surprise, I was expecting that the yes answers will prevail. With no, the biggest part of the respondents are saying that they prefer personal contact. Second comes the answer, yes, because of enough time for information and decision. For example, in family environment or discussing with friends. And I think this very well represents the current situation in Bulgaria. And this leaves room for both offerings, for physical offering and for digital offering. Thank you for your attention. I'll be happy if there are questions.
This was the final presentation for that session. I want to ask now the audience, is there any questions to our participants? No, if there is no, I want to thank you all for today's third session in our conference, and I want to announce that our fourth panel will start at 1:30 p.m. and the theme of the fourth panel will be holistic approach to the risk assessment and management of long-term retail savings and investment products. I think it will be really interesting because in this panel we will have participants like Professor Priedru Muratu from Universitatea Catolică de la Scolo Coate from Milan, Professor Hans van Martin from the University of Utrecht, Cvetomir Iliev, Chief Investment Officer of Allianz Bulgaria Holding, Dr. Nikolai Slavchev from Bulgarian Association of Supplementary Pension Security Companies, Dr. Zhivka Nikolova, Bulgarian Academic of Science, and so on, so on. So we will expecting you again after the lunch break in 1:13 p.m. Have a nice lunch. Thank you for once again.